Now, you know, and I know that XRP's been moving recently, right? Big round of applause for XRP. Big round of applause for everyone who stayed in XRP all that time. But I do get a question a lot, and that question is, when this bull run happens, what do I do? Like, what do we do after this bull run? When the prices have all gone up, what is the plan of action? But rather than me give you a specific strategy here, I want to actually just give you all the options. So you can lay them all out on the table. These are all the things you can do. And you can look at that list and say, hey, this one aligns, this one doesn't, or maybe this one does and part of this one does. And you can start to build the framework for a strategy post bull run. So if you're new here, welcome to the club. My name's Lewis Jackson. I help investors just like you create strategies for making more money and building wealth over time to ultimately build generational legacy. So if you do enjoy this video and you're all about that kind of vibe, that generational wealth vibe, click subscribe on this video and share this video with anyone else you know who also might be interested. There's a ton of you that watch these videos that aren't subscribed, so go ahead, just click the button and let's move on. I want to emphasize here that no one strategy is the right way to do it. The right way to do it is the way we're going to get into it at the end, right? So I just want to put that out there. If I'm going to say some things here that might trigger you, but they only trigger you because they're the opposite of what you would do. And just because it's the opposite of what you would do doesn't mean it's wrong. So let's get into the first one. The first one is that we can simply take profits on our crypto and pay the capital gains tax. Now, in some situations, this actually is going to work out way better for you. And that might be surprising for you to hear, but even recently in my life, you know, we've had the altcoins they've been moving. I've been taking profits along the way because I do believe at the current moment of filming this, we're about halfway through the bull run already. And I've been without a car for about 2 months now. I was away in Nicaragua, just being with family for the New Year and Christmas. And when I came back, still no car. There's only so long you can drive a Beta before you need to upgrade. So it was that moment for me. We had to buy a car. We got another kid coming in March. So we had to buy a car. So I called up my accountant and I said, hey, accountant, these are all the different ways I can imagine paying for this car. You know, I've got a business. I can use the business funds. I can pay in cash with the business funds, or I could use a business credit card, or I can use a 0% credit card for 22 months and pay it off. Out of all of these options, what can I do? And he said, basically, the crypto that you hold is in your personal holdings. In the UK, that seems to be the best, most tax efficient way. If you're in the US, holding it in an LLC has benefits if you register that LLC as an S corporation. He basically said, the best way to buy this and pay the least amount of tax is for me to use profits from my crypto and buy it outright and pay that capital gains tax. That was the most tax efficient way to do it. That's interesting because everyone considers paying capital gains tax as the last resort. Very interesting because for me, in that specific situation where I needed to buy a car, the best option was to just pay capital gains tax and take profit. So I'm only positioning that as one of the many options that we're going to cover in this video. But I do want to say that it might not be the worst option for you. Another option that you might consider is actually taking profits on the entire portfolio. Shock horror. You might actually do that. Some people might do that. Reassign that entire value of the portfolio into cash flowing assets. Now, this might become especially important for you if you're on the tail end of a strategy, you've taken your profits, and actually crypto is too stressful for you. Like this isn't where you wanted to go. Or potentially you've reached your goals. If you've got really well-defined goals, certainly in any investment, but specifically in crypto, like the students in my BlockFlow program do, if you're offered that opportunity to achieve all of your financial goals right now, but the caveat is you have to sell your cryptocurrency in its entirety, honestly, would you take that offer? I'd like to know actually in the comments. If you would take that offer, everything you've ever wanted financially, here it is, but you accept no more, would you take it? Yes or no in the comments to that question, please. Again, no judgment, and don't judge anyone else for the answer that they give. The decisions people make, the decisions I make, the decisions you make should be made for you and your family, not based on what other people tell you should be doing with your money for your family. But the idea here is that you take your money out of your crypto, like you're moving the value here. You move the value from your crypto portfolio into something that generates cash flow. We've been exploring a whole range of ideas here with small, boring businesses. You know, when I say here, I'm talking about with my members in the program. We're talking about buying like accountancy firms, maybe a coffee shop, maybe vending machines, maybe a parking lot. These kind of abstract ideas that are just super boring, but make a ton of money. And they make money consistently. So there may be opportunity for you to diversify that entire portfolio from crypto into something that just generates cash flow. Because if that cash flow is sufficient enough to pay your desired lifestyle, why would you not take that? Now, the other option here, and this is one that might resonate with quite a few people, although you're going to need to be switched on to do this. You might want to take your profits. Maybe that's the whole portfolio or not all of it, and just a portion of it, but we'll get into that in a second. And you might just look for market dips. The purpose of this is to accumulate more tokens. The priority here isn't necessarily value. The value is secondary to the accumulation of tokens. So let's say you sold all your XRP, you wait for a big crash, you buy more XRP. Very simple. So it's more of a trading strategy, but certainly on the table for you as well. What about some options if you actually are not selling any of your assets at all? Well, one way of doing this is that you can actually collateralize the assets you have and actually take a loan out against your assets. So you're saying basically to the platform that you use, here's the value of my portfolio. It's verifiable. It's all on the blockchain. Can I have an immediate loan? Because they give it to you instantly. And you take that loan out and use that loan, which was tax-free, by the way. That money was tax-free that you've just taken out because debt is tax-free. Then you use that debt to do a variety of different things, right? You could use that debt to accumulate more crypto in dips, right? In big crashes in the market. You have to use some of that. You could maybe use for paying down margin calls if the price of the collateralized asset went down significantly enough. Or you could use a portion of it. And I'm saying all, but I'm also saying and. I would suggest you do all of these things. You could basically identify a portion of that would actually go to diversified cash flowing things like those vending machines or the car parks, whatever it is. But you want to diversify slightly outside of crypto, but also hedge in crypto and hedge against the price of the assets going down as well. So there's a whole strategy to that. I'm actually coining a strategy as part of my block flow kind of linear methodology here. And I'm calling it the 33, 50, 25, 25. It's not, I need to work on the name. I think I need to work on the name. It's too long, bit of a tongue twister. I can't even say it. So the idea of that is that you take a 33% loan to value on your assets, which is, I would say, in that secure realm. You're saving 20% of the loan that you take, or 25% of that loan that you take, and keeping it in stable coins so you can pay down a margin call if that happened. 50% of that loan is actually being used to accumulate more tokens to build up your personal treasury, essentially in XRP. And then a remaining 25% that you're using to diversify into other cash flowing assets. The winning situation here is that you get to accumulate assets and you also get to pay off the loan with those cash flowing assets that you buy with that 25%. So that's obviously the ideal way to work things out. There's a tremendous amount of risk in that strategy. It's not for everyone, but it's one of those options. The other option you can take advantage of is trying to earn a yield by staking or contributing to an AMM of sorts. We've talked about AMMs on this channel. I explained AMMs in massive detail in the video. It's somewhere on the screen right here. If you want to go and watch that, please do, because AMMs are super interesting, especially on the XRP ledger, using XRP and any assets that work on that blockchain. AMMs are interesting because you contribute money, you provide liquidity, and you get paid a yield, essentially, or a portion of the fees that are used when transactions made. I don't want to go too into depth with that, but basically sometimes there can be a very consistent yield that you can generate. So you put a certain amount of value in and you get a specific percentage back. Now, my experience with AMM so far hasn't been the best. It's not been too consistent. I just want consistency at this point. I'm not looking for massive yields or massive returns. I just want sufficient return to pay my lifestyle. Sometimes that's going to require, depending on your lifestyle cost, either a larger or a smaller portion of kind of a lump sum that you put in the AMM. But for me right now, I've seen yields in AMMs of plus 14%, and I've also seen negative yields from AMMs. Like, I just don't want to participate in that kind of environment. But everyone to their own. It might be quite appealing to you, but it's an option. Another option, if you're not selling your assets, is simply to hold. And I think that's where a lot of people mentally put themselves, because it helps you manage the whole idea of the price going up and price going down. If you just accept that you're holding and that's the way it is, it's going to be a lot easier to manage your emotions in that time. But I do think you miss out on a lot taking that strategy. But if you did want to take that strategy, I want to warn you of something that you might not have considered. In this bull run right now, if you are a complete hodler, like no selling whatsoever, you'll have seen your portfolio go up multiple thousands, tens of thousands, if not hundreds of thousands. Or the top clients that I have, they're seeing millions of dollars be added to their portfolio in this little move here. If you are hodling and you're not doing anything else other than holding, you will most likely, 99% likely, see that value of that portfolio go all the way up into the hundreds of thousands or millions, whatever it is, and come mostly all the way back down. You have to prepare for that. If you are accepting that you're going to hodl, it's likely that you will have to watch the portfolio go down to that degree again. Almost, and it will make you feel like you've lost millions of dollars because you will have seen those millions of dollars in your portfolio and now they're not there. I even felt this yesterday. I was kind of a little bit gambling on the Trump inauguration, right? So I went into the market. I had a pot of capital that I wanted to kind of put up for risk here in a more tradey, leveraged environment. And I thought, okay, let's see what we can do with this Trump inauguration and what the price is going to do. I made a series of wonderful decisions and one bad decision, but it's going to explain the hodl mentality as well. So in this trade, I entered at about $20,000, right? I seen the price go up. It went up to $35,000. And I was like, okay, I've just made a year's salary for someone in the UK. I've just made a year's salary and it was literally like 5 minutes. And I thought, I'll just hold it. I think it's probably maybe got a little bit more upside. And what happens? It comes crashing down. I even lose money on that trade. So I end up with $14,000 in the pot in the end. I don't look at that as I lost $6,000. I look at that like I lost $17,000. Right? I look at it as I had 35 and now I've got 14. But I didn't realize that profit. So I never had that money. I really only ever had $20,000 and it went down to 14. Yes, that's a heavy hit. And I've since actually regained that position because the market's kind of bounced back a bit. But the hodl mentality means you have to accept the idea that you're going to watch your portfolio go up and go down. And if you've got the stomach for it, wonderful. Just continue accumulating with any side capital that you have over time. But if you feel like put yourself in that position right now, if you feel like that's a bit of a worry, you might want to side or err on the side of caution. Maybe you want to hodl most of your portfolio, but I would suggest there is a number out there, a percentage of your portfolio that you actually would be happy taking profits on. So I'm going to tackle something here. We've gone through a few options, but I want to ask you the question, what makes a strategy actually good or useful? You would think it's just about money go up, right? But a strategy is more than that. If you see money go up, it doesn't necessarily mean money's going to stay up, but strategy allows it to stay up. You maintain value. I think that the real important thing here is that I think everyone should have a little drop of this mentality where you're not married necessarily to a crypto or a specific token, but you are married to the value. So you want to do everything you can to maintain the value of your assets. Now, it's not necessarily, and this is going to be controversial, it's not necessarily important that that value is held in crypto. As long as the value can be held and secured and you're mitigating against downside, value can be held in many different areas. Now, if your lifestyle, if you say you've got a massive portfolio of $10 million, right? You don't need a massive yield to generate your ideal life, right? Or maybe you do. Maybe your life costs a lot of money. But the important thing is here that everyone is different, and therefore a good strategy for you is a different strategy than what's good for me. So the most important thing here, and I'm going to be talking about this a lot on this channel, and I do so on my Instagram. If you want to follow me there, it's my close friends list that you join. The link is in the description to follow me. But I'm really trying to align everything I do right now with values. Not necessarily the most upside, but actually more according to my values and the vision that I have for my family and generational wealth. The moment you make that distinction, that change, you stop chasing weird coins or weird projects and stop focusing on things that actually feel authentic to you. You start changing your decision making, your emotional responses to things are all geared around your values, right? So actually a good strategy is simply one that aligns with your values and makes you some money as well. Anyway, if you enjoyed this video, please share it with someone that you also think might enjoy it. There is a video that I've made a week ago or so that I think is required viewing for not just XRP holders, but also crypto holders in general. So make sure you click the video. It's here somewhere. Click that video next, and I'll catch you in the next one.